Welcome to YCC Capital Macro Research. We don't follow headlines, we follow the data. Every day we analyze the world's largest economies, financial markets, and geopolitical developments to uncover the structural forces shaping tomorrow's investment landscape. Let's begin. Europe entered 2026 hoping that the worst of its energy crisis had passed. Instead, the region encountered a new reality. Energy prices surged again after geopolitical disruptions. Inflation reaccelerated, investment weakened, and external trade remained under pressure. While recession has largely been avoided, the recovery has become increasingly fragile. Throughout this presentation, we'll examine what the latest economic data tells us about growth, consumption, labor markets, and the broader outlook for Europe. More importantly, we'll explore why stabilization should not be mistaken for a strong recovery. Euro area GDP quarterly growth, QOQ, and expenditure decomposition. Our first chart illustrates how different components of demand have contributed to euro area GDP growth over recent quarters. The most immediate observation is that quarterly GDP has become increasingly volatile, and by the first quarter of 2026, the economy slipped into a modest quarterly contraction. Although the decline was relatively small, it marked an important shift in momentum after several quarters of slow but positive expansion. Looking beneath the headline, the composition of growth tells a much richer story. Household consumption has remained one of the more consistent sources of support. Consumers have continued spending despite persistent inflation, helping prevent a deeper slowdown. Government consumption has also provided stability, cushioning private sector weakness. However, the more cyclical components of the economy have deteriorated noticeably. Gross fixed capital formation, representing business investment, has weakened as companies face higher financing costs, elevated energy prices, and greater uncertainty surrounding trade policy. When businesses delay investment, today's weakness often becomes tomorrow's slower productivity growth. Net exports have also become a meaningful drag. Higher energy import costs combined with weaker exports have reduced Europe's external contribution to growth. Inventories have fluctuated significantly as firms adjusted production and supply chains in response to changing demand. An economy can sometimes resemble an aircraft flying on multiple engines. As long as several engines remain operational, the plane continues moving forward. But when investment and exports begin losing power simultaneously, the remaining engines, household spending, and government expenditure must work much harder simply to maintain altitude. That is precisely the challenge Europe now faces. According to our assessment, Europe is transitioning into a prolonged period of low growth normalization rather than entering a powerful cyclical recovery. Major European countries. Quarterly GDP growth, QOQ. The aggregate euro area often hides substantial differences between individual countries. This chart highlights those divergences. Spain continues to stand out as the strongest major economy in Europe. Quarterly GDP growth has remained consistently positive, supported by tourism, renewable energy investment, agriculture, and relatively resilient domestic demand. Spain has become one of the few bright spots delivering sustained economic momentum. Germany presents a more complicated picture. Growth has stabilized after previous weakness, but its manufacturing-heavy economy remains highly exposed to elevated energy costs and weaker global trade. While recent quarters show modest improvement. The underlying industrial environment remains fragile. France experienced weaker domestic demand and softer business confidence, leading to more uneven quarterly performance. Consumption has slowed while investment remains cautious. Italy has demonstrated comparatively steady growth. Although not experiencing rapid expansion, moderate domestic demand has helped avoid the sharper volatility seen elsewhere. The United Kingdom, while outside the euro area, provides an important comparison. Quarterly growth has improved in recent quarters, but some of this apparent strength reflects temporary factors rather than a broad-based acceleration. These national differences remind investors that Europe is not a single homogeneous economy. Countries with stronger service sectors, tourism exposure, or greater energy independence have generally performed better than economies relying heavily on energy intensive manufacturing and exports. Understanding these structural differences will remain increasingly important as investors allocate capital across European markets. Euro area retail sales index, year over year and month over month growth. Consumer spending is often described as the backbone of developed economies. This chart helps us understand whether that backbone remains healthy. Following the dramatic swings during the pandemic, retail sales gradually normalized. However, the first half of 2026 shows that momentum has begun slowing once again. Year over year, retail sales growth remains positive, but it has moderated compared with earlier periods. Month to month movements have become increasingly subdued, suggesting households are becoming more cautious. This behavior makes economic sense. When energy bills rise, families rarely eliminate spending altogether. Instead, they begin making small adjustments. They postpone replacing appliances, reduce discretionary purchases, delay vacations, or save a larger share of income as protection against future uncertainty. Individually, these decisions appear insignificant. Collectively, millions of similar decisions create measurable weakness across the entire economy. Although labor markets remain relatively stable, slower wage growth means real purchasing power has become increasingly constrained. At the same time, higher energy prices continue absorbing a larger share of household budgets. Consumer confidence has improved somewhat as geopolitical tensions eased, but confidence remains below previous levels. Our conclusion is that household consumption should continue supporting the economy, but only modestly. Consumers are unlikely to generate the type of spending boom typically associated with strong economic recoveries. Major European countries' retail sales index, year over year growth. National retail sales data reinforces the divergence already observed in GDP. Germany's retail sales remain highly volatile. Consumers continue responding sensitively to changes in inflation, energy costs, and economic confidence. Spending has improved at times but has struggled to establish a consistently upward trend. France has exhibited considerably greater stability. Retail sales have maintained relatively steady positive growth, reflecting a more balanced consumer environment despite broader economic challenges. The United Kingdom has delivered the strongest recent retail performance, particularly toward 2026. However, investors should interpret this strength carefully. Some of the improvement reflects favorable statistical base effects, higher nominal prices, and seasonal influences rather than a dramatic increase in underlying purchasing power. In other words, stronger headline retail numbers do not necessarily imply a fundamentally stronger consumer. For policymakers, these differences matter because monetary policy affects each economy differently. For investors, they highlight why broad regional averages sometimes conceal meaningful opportunities and risks beneath the surface. Selective country exposure may therefore become increasingly valuable during an environment characterized by uneven economic performance. Euro area unemployment rate and wage growth. Our final chart focuses on one of the most important relationships in macroeconomics, the interaction between labor markets and wages. The euro area unemployment rate has gradually declined over recent years and has remained near historically low levels around the mid 6% range. At first glance, that appears encouraging. However, wage growth tells a more nuanced story. Following exceptionally strong gains after the pandemic, wage growth has steadily moderated. Companies facing higher financing costs, weaker investment, and slowing demand have become increasingly cautious about raising compensation. This creates an important balancing act. Stable employment supports household incomes and reduces recession risks. Yet slowing wage growth limits future consumption because disposable income expands more slowly while inflation remains elevated. Central banks are watching precisely this relationship. For the European Central Bank, imported energy inflation creates a particularly difficult policy challenge. Higher interest rates cannot produce more oil or reopen disrupted shipping routes. Yet allowing inflation expectations to become unanchored would create even greater long-term problems. As a result, policymakers are likely to remain highly data dependent. Our baseline expectation remains that the ECB pauses rather than embarks on an aggressive tightening cycle, provided energy prices gradually normalize during the second half of 2026. Nevertheless, inflation risks have not disappeared entirely, meaning policy flexibility will remain essential. Euro area and EU consumer confidence index economic recoveries are driven not only by hard data, but also by psychology. Consumer confidence often acts as an early warning signal because households adjust their spending long before those decisions appear in GDP or retail sales statistics. When consumers feel uncertain about the future, they become more cautious, increasing savings while postponing discretionary purchases. This chart illustrates exactly that dynamic. Following the recovery from the pandemic, consumer confidence gradually improved through 2023 and much of 2024. Although optimism never fully returned to pre-pandemic levels, households were slowly regaining confidence as inflation moderated and labor markets remained resilient. However, the renewed energy shock during early 2026 interrupted that recovery. Both the euro area and the broader European Union experienced a sharp deterioration in consumer confidence as geopolitical tensions in the Middle East pushed energy prices higher once again. Higher electricity bills, rising fuel costs, and renewed inflation immediately affected household expectations. What's particularly noteworthy is how closely the euro area and EU confidence indices move together. Despite differences among individual countries, European consumers are responding to the same overarching macroeconomic forces. There has been a modest rebound as geopolitical risks have eased, but confidence remains well below its 2025 average. That tells us households are no longer in crisis mode, yet neither are they comfortable enough to significantly increase spending. Confidence, like trust, is difficult to rebuild. It can decline within weeks, but often requires years to recover fully. That lingering caution helps explain why Europe's consumer recovery continues to look restrained rather than robust. Euro area and major countries' manufacturing. PMI manufacturing has become one of Europe's greatest economic challenges. The Purchasing Managers' Index provides one of the earliest snapshots of industrial activity. Readings above 50 indicate expansion, while readings below 50 signal contraction. For much of the past 2 years, manufacturing across Europe has struggled to remain consistently above that threshold. Germany remains the weakest link. As Europe's manufacturing powerhouse, Germany is particularly exposed to elevated energy costs, slowing global trade, and increased competition from Chinese exporters. Although recent PMI readings have improved, they only indicate stabilization rather than a strong industrial revival. France has followed a similar path. Manufacturing activity has gradually recovered from its lows, but businesses continue facing weak export demand and cautious investment. The euro area aggregate reflects these same challenges. Manufacturing has slowly climbed back toward expansion territory, yet momentum remains modest. The United Kingdom has shown comparatively stronger resilience, with PMI readings remaining above many continental peers. Nevertheless, even British manufacturers continue facing higher input costs and a less supportive global trading environment. Overall, the message is clear. Europe's factories are no longer in free fall, but neither are they entering a new expansion cycle. Instead, the manufacturing sector appears trapped in a slow normalization process, constrained by structural rather than purely cyclical headwinds. Euro area and major countries' services. PMI unlike manufacturing, Europe's services sector has provided much of the economy's resilience over the past several years. Services account for the majority of employment across developed European economies, making this sector especially important for overall growth. This chart shows that services activity has generally remained closer to the expansion threshold than manufacturing. However, the trend has softened considerably during 2026. The euro area services PMI has drifted lower as consumers become increasingly cautious and businesses reduce discretionary spending. France has experienced the weakest performance among the major economies. Slower domestic demand and declining business confidence have weighed on service sector activity. Germany has remained relatively stable, despite broader industrial weakness, while the United Kingdom has generally maintained stronger service sector momentum than much of continental Europe. Even so, all major economies show signs of moderation. This matters because services had previously compensated for weakness in manufacturing. If both sectors begin slowing simultaneously, Europe's overall growth engine becomes significantly less powerful. The economy resembles a two-engine aircraft. Manufacturing has already been operating below capacity for some time. If the services engine also begins losing thrust, maintaining steady growth becomes increasingly difficult. That is precisely why recent PMI data deserves close attention. Euro Area 20 country, industrial production. Index. Industrial production offers perhaps the clearest measure of Europe's structural challenges. The pandemic created unprecedented swings in output, followed by a rapid recovery. Since then, however, industrial production has settled into an extended period of stagnation. The year-over-year growth rate has fluctuated around zero, while monthly production changes have remained volatile without establishing a sustained upward trend. This reflects several persistent pressures. Energy-intensive industries continue facing elevated production costs. Supply chains remain vulnerable to geopolitical disruptions. Trade uncertainty discourages long-term capital investment. Meanwhile, manufacturers continue adapting to intensifying global competition, particularly from lower-cost producers. Although lower oil prices should eventually ease some cost pressures, rebuilding industrial competitiveness takes considerably longer than reducing energy bills. Factories cannot instantly reverse postponed investment decisions or rebuild supply chains that have already shifted elsewhere. Consequently, we expect Europe's industrial recovery to remain gradual and uneven throughout the remainder of 2026. France Industrial Production Index France presents an interesting contrast within Europe. Compared with Germany, France benefits from greater energy independence due to its significant nuclear power generation. This has helped shield portions of its industrial sector from the full impact of higher global energy prices. The industrial production data reflects that relative resilience. While output has experienced normal month-to-month volatility, year-over-year production has remained comparatively stable during recent years. France still faces weaker external demand and slowing business investment, but its industrial base has avoided the more pronounced deterioration observed elsewhere. Sectors such as aerospace, defense, pharmaceuticals, and luxury goods continue providing important support. As a result, France's industrial sector appears to be stabilizing rather than contracting. This relative resilience does not imply strong growth, but it does suggest France enters the second half of 2026 from a somewhat stronger position than many of its European peers. Germany Industrial Production Index. Germany's industrial sector deserves special attention because it remains the backbone of Europe's manufacturing economy. This chart illustrates why Germany continues to face the greatest structural headwinds among Europe's major economies. After the dramatic pandemic fluctuations, industrial production recovered briefly before settling into an extended period of stagnation. Year-over-year production has struggled to establish sustained positive momentum, while month-to-month output remains highly volatile. The reasons are largely structural rather than temporary. Germany's economy relies heavily on energy-intensive industries such as chemicals, machinery, automobiles, and heavy manufacturing. These sectors have been disproportionately affected by higher natural gas and electricity prices following successive geopolitical disruptions. At the same time, Germany's export-oriented business model faces growing pressure from weaker global demand and intensifying competition, particularly from Chinese manufacturers in sectors such as electric vehicles and industrial equipment. Businesses have become increasingly cautious about expanding production capacity. Instead of aggressively investing, many firms are focusing on cost control, efficiency improvements, and supply chain diversification. While lower energy prices should gradually improve profitability, rebuilding industrial competitiveness will take considerably longer. In our view, Germany's manufacturing sector is transitioning from contraction towards stabilization, but it has not yet entered a convincing expansion phase. As Europe's largest economy, Germany's recovery will remain one of the most important determinants of the broader euro area outlook. U.S. imports from the euro area and trade growth. Our final chart examines one of Europe's most important export markets, the United States. For many years, American demand has served as a key source of support for European manufacturers. However, recent data indicate that U.S. imports from the euro area have weakened noticeably on a year over year basis. Part of this reflects slower global demand, but trade policy uncertainty has also played an important role. Although tariff disputes no longer dominate financial headlines as they once did, businesses remain cautious about committing to long term investments, while trade negotiations continue evolving. The temporary surge in pharmaceutical exports during 2025 also created unusually difficult comparisons, making subsequent growth appear weaker. Encouragingly, the latest data suggest that year over year declines are beginning to moderate. This indicates that trade conditions may be stabilizing rather than continuing to deteriorate. Even so, the recovery remains fragile. Europe cannot rely solely on stronger exports to drive its next phase of economic expansion. Instead, sustainable growth will require healthier domestic consumption, renewed business investment, improved industrial competitiveness, and greater geopolitical stability. Taken together, the trade data reinforce the broader conclusion of this report. Europe has successfully avoided a deep recession, but the economy has not yet escaped the long shadow cast by higher energy costs, persistent geopolitical uncertainty, and structural challenges. The recovery is underway, but it is likely to remain gradual, uneven, and highly dependent on continued improvements in both the domestic and global economic environment. Bringing everything together, the data points toward a consistent conclusion. Europe is stabilizing, but stabilization should not be confused with acceleration. Growth remains constrained by elevated energy costs, cautious business investment, persistent trade uncertainty, and slowing consumer momentum. While lower oil prices could gradually ease inflationary pressure, the structural effects of recent shocks will likely take much longer to reverse. For investors, this environment favors discipline over optimism. Companies with resilient balance sheets, durable pricing power, and lower dependence on energy intensive production are likely to outperform as Europe navigates a prolonged period of modest expansion. At YCC Capital, we believe successful investing begins with understanding the structural forces shaping the global economy, not simply reacting to the latest headlines. Thank you for watching YCC Capital Macro Research. We look forward to seeing you in our next market update.